Hi everybody, Lynette Zhang, Chief Market Analyst here at ITM Trading, a full-service physical precious metals brokerage house. Well, today we're going to talk about the VIX, the Volatility Index, and what it's really telling us and why it actually matters and how it impacts you. Okay, but I'm going to start with, we've noticed how calm the markets are. Even in the face of what happened in North Korea testing a nuclear warhead that could reach the U.S. over the weekend, and the global computer, well, it wasn't actually a hack, but the ransomware that was distributed globally, okay? And the markets yawned. Well, let me show you why they must yawn at this point. What you're looking at is a piece from the government showing how whatever you have deposited into your accounts can be used by other financial institutions. So where I've put a star is typically where most people hold their wealth in one of those places. It could be a REIT, it could be a money market, it could be a mutual fund, etc. And anything you have in there flows throughout the system, and they can use that wealth to borrow on their behalf. We've talked about that. That's called hypothecation. And it's also called pledged collateral. So you can see from this most current report by the Office of the Comptroller of the Currency that the banks globally use all of that collateral that's in the system to, and we're going to talk about derivatives in a couple of minutes. The blue line is from 2007, and so you can see that Bear Stearns and Lehman don't exist anymore, but you can also see that a number of banks are using more and more of that collateral. So they need you to keep the wealth inside of the system. How can they get away with this? Well, from a recent Yale study, they certainly admit whether you're an institution or an individual, everybody realizes that the stock market particularly is severely overvalued. But they count on the stocks continuing to go higher, the greater fool theory. Because what they expect is that central banks will continue to inject capital into these markets, that they can keep everything propped up and you hold your wealth inside of there, right? In fact, they openly talk about a freakish calm in all of these markets. So what you're looking at here, this blue line here is the VIX. And the white line is the, what is that? The S&P 500 price earnings ratio. And you might notice that just before the crisis hit in 2008, the VIX was at 2021. So in other words, people were really pretty calm about what was happening in the markets. Then just not even 2 months later, it hit 86 when people were really scared. And that was in November of 2008. Today, just before we came on, I pulled it, and we were at 1051. So it's significantly lower than it was just before the last crisis became apparent to everybody. This bottom line shows you the VIX compared to the price earnings, or the value, well, the price earnings of the stocks. And you can see that it's higher than it was in 99. So this is really not a good thing. You're counting on the fact that nothing bad would happen and ignoring all of these major events that are unfolding. Are you keeping your wealth in there because the stock market is so high? Because you can see from this that the Dow has, or the S&P 500 has gone more days without a 1% decline than since they started keeping records of this. So, hey, nuclear test successful? Ho-hum. Not really. The markets are being artificially supported. But there's also a break in this. This is an exchange-traded fund called the XIV. Okay, and you can see that it's been rising on this calm. This is a way for an investor to bet that the markets will remain calm. And you can see that it's been rising. So if you go to your stockbrokers, you're going to go, oh, they're doing so well, and et cetera, et cetera. And by the way, it's rising on declining volume. But looking a little bit underneath at what Wall Street is really doing, and this is really unusual. I don't know if you could see this, so make sure you go in and look at these links. But Wall Street has sold more than 172% of the shares outstanding. So that means that they know this market is going to crash and they're positioned to take advantage of it. But if they've sold 172% of the shares outstanding, what do you think happens to that fund when they go to collect? And that's not the only example. I can see more examples that exactly look like that. So it shows you that this market is severely broken. But this is the most important graph that I am showing you today, because this is the volatility index on the 10-year Treasury, which is classified as the safe haven trade and is supposed to be the bedrock foundation of the global financial markets, all of them. Okay, so look at this. First of all, they created the VIX on the Treasury in 2003, so it didn't exist before that. But if you look at this line, and I'm going to come up close so you can see you see that those are dashes? Just little dashes. Well, these dashes mean that the price movement on the 10-year Treasury was not great. So that would make sense as the foundation. So if you woke up in the morning and you were going to buy or sell a Treasury, you pretty much knew what the price of that Treasury was going to be. But look at what happened in 2008. Those dashes became lines. And this is when the central banks put the markets on life support. Okay, but look at what happened in 2013. Those reasonably calm lines, I guess you could call it, became extreme. And what that shows you is that the traders have taken over. Could be high frequency trading, but the traders have taken over the 10-year bond market, at least in regards to this. Can you see that pattern shift from bedrock to life support to extreme? Because if this were an EKG, this would tell you that you're having a heart attack. How long can that keep up? Till it gets too expensive. But now I'm going to show you why, and we're going to wrap up. This is, again, from the most current report from the Office of the Comptroller of the Currency. And these are derivatives in the FDIC insured banking system going through the fourth quarter of 2016. This is where the crisis hit, 2008. And you can certainly see that they are trading a whole lot more stock derivatives than they did before. And they haven't really eased off on the interest rate derivatives either from 2008. And keep in mind that a derivative is based upon, or its current market value, I should say, is based upon the price movement of the underlying. So they are really counting on stocks to stay stable. Do you see that? You see why that matters? And here's a little piece in here from that same report showing the derivatives in those FDIC insured banks, derivatives to assets, which would include your deposits. So for JP Morgan Chase, for every $1 of assets, they have $22.81 worth of those bets. For Citibank, for every dollar, it's $32.55. Goldman Sachs, for every dollar, $219.25. Bank of America, $12.60 for every dollar. So you get the point that if there is a derivative implosion, when these markets move at too wide a range, it's going to trigger those derivative bets and it'll take down the whole system. And this is just in the FDIC insured banks. And oh, by the way, on gold, here's the graph from that same report on spot gold. And you can see, here's 2008. This is where we are right now. And this is just one little area where they can sell a whole lot of derivative gold and move those prices. I've shown you the COMEX. I've shown you other areas where they can do that manipulation as well. It's layers. It's layers of leverage. It's layers of bets. It's layers of everything. And you, my friend, if you have any wealth in the system, you are not the legal owner of anything but a contract. And any contract is only as good as the counterparty to that contract. And let me tell you, if they're selling all of these things and they're trading this, they need your wealth in that system. They're getting out. We look at that every week. I always suggest you do what the smartest guys in the room on any given topic are doing for themselves. I've just shown you why they need these markets calm. You be smart and you take care. So that's it for today. Follow us on Twitter. Like us on Facebook. Subscribe to the YouTube channel. We'll let you know when we're doing these lives. And give us a call, 888-696-4653, and share. Share this with everyone and be careful out there. Bye-bye.